Now, there's another important issue to be aware of when it comes to lower costs, when it comes to inventory. And that is what's called lower cost to market. And if you look at any company's financial statements, they'll tell you that they use lower cost to market. And let me explain how this works. We'll talk about as an example Home Depot, and they use FIFO. So the concern is that your inventory may go down in value. So if you record inventory at cost, it's very possible that the inventory has lost value for some reason, and therefore its value by the end of the year is worth less than you paid for it. So what would happen is that you need to write it down. And that idea is called lower cost to market. Basically, the deal is that at the end of each year, the company needs to assess what the cost of its inventory is, and it also needs to assess what the market value of the inventory is, i.e., how much would it cost you to replace this inventory. If the market value is lower, then the company needs to reduce the book value of its inventory to market value. And this is called a write-down. Therefore, when you see in a company's financial statements that the company is using lower cost to market, that means that, and all companies have to use lower cost to market, that if the market value is less than the cost, then they need to record a write-down. So here you can see Caterpillar reported 2 ways, and also another company named Kubota, which is a Japanese company. And CAT uses LIFO, as we said before, and LIFO represents, under LIFO inventory, is 12% of Caterpillar's assets. If you were to restate their inventory to FIFO, inventory would be almost $2.5 billion higher, but total assets would also be $2.5 billion higher, and therefore inventory as a percentage of assets would be 15%. If you're interested in inventory as a percentage of assets, then look at Kubota, which is in the same industry. That's 14% of assets, and that's using FIFO. Here you can see the cost of goods sold. Cost of goods sold would be slightly different under each method. And here's revenue would be the same. So cost of goods sold as a percentage of revenue would also be affected. And again, here are numbers for another company named Kubota in Japan. So if you're going to adjust your balance sheet for LIFO, there are 3 changes that you need to make. And whenever we talk about accounting choices that companies make, we're always going to be talking about how to adjust the balance sheet and how to adjust the income statement. So one thing you're going to do is you're going to add the LIFO reserve back to inventories. You're also going to increase any tax liabilities, adjusting for the tax rate up against that LIFO. So basically be the LIFO reserve times the tax rate. And you'd also increase retained earnings for the difference between these. So you would have actually 3 adjustments to your balance sheet. Debit or increase inventory for the LIFO reserve, increase deferred tax liability. They say here tax liability, but the exact account would be deferred tax liability. Current. That would be the exact. It would be current because inventory is current. And the difference would go to retained earnings. So that's how your balance sheet would be affected. And here you can see the specific changes. Now for a LIFO reserve, on the income statement, we need to adjust cost of goods sold from LIFO. And this is a little tricky. You're going to use the change in the LIFO reserve to adjust cost of goods sold. So you'd start off with LIFO cost of goods sold, and you would subtract the increase in the LIFO reserve or add the decrease in the LIFO reserve. So in this case, I have an increase in the LIFO reserve of $68 million. So it'd be cost of goods sold of $33,742 minus this increase, giving me adjusted cost of goods sold of $33,674. And it doesn't say it here, but what you're also going to do is you're obviously going to adjust your income taxes too. You'll adjust all the items below it because cost of goods sold is now changed, so that means gross profit is going to change, operating income, income before income taxes is going to change. Provision for income taxes is also going to change by the amount of the difference times the income tax rate. Now, this is something very tricky. I was saying before that with LIFO, you have the possibility of what's called a liquidation. What could happen is that companies, remember, you have this old inventory sitting in the back of the shelf, and it may be very old, and it may be priced at a very, very low cost. So you've been saving taxes all along. The problem is that when you sell that inventory, it's at a very, 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 very low cost. Because think about, like when I have kids, and like sometimes I'll say to the kids, I'll pay some ridiculous amount of money for something. I'll pay $2.50 for soda at the convenience store now. Like a 20-ounce bottle of soda is $2. And I remember when I was a kid, you get a soda for 25 cents. And the kids are like, yeah, whatever. Well, you know what? This is really important when it comes to LIFO. Because that old box of stuff that's sitting on the shelf costs very little. And if the company ever sells it, it's going to have a lot of gross profit. And along with that gross profit is going to be a lot of taxes. So LIFO liquidation could occur because the difference between FIFO and LIFO, that tax difference is what's considered to be temporary. In other words, you're saving money on taxes now, but you're going to have to pay money on taxes later on. You're saving money on taxes now, you're going to have to pay more money on taxes later on. But sooner or later, you have to recognize that income. So one day you're going to sell those very cheap items that were at the back of the shelf, so to speak. They're going to have huge gross profit, which is going to distort your income. And they're also going to have huge income taxes. So that could occur. And that's something to be aware of. Sometimes companies do have LIFO liquidations. And these primarily happen when companies are in trouble, they're in distress, they're closing down stores, and things like that. You should be aware that, again, with the new Tax Act, the tax savings on them can actually be permanent. Because what would happen is if you can move that income from a high tax period into a low tax period, then you really save money on taxes. So if you were avoiding taxes prior to 2018, because tax rates were higher, and you shifted the income to the later periods when tax rates are lower, then that additional income will be taxed at a lower rate, and then you really would save money on taxes. So because of the reduction in the tax rate that is occurring right now in 2018, you're actually going to save a lot of money on taxes.